Hello, everyone. Hope everybody is doing well. Well, I made a forecast video for 2020 indicating that I wasn't as bullish as I was in 2019. And although I did see a significant sell-off in the markets, I did not really expect this to be so drastic and hard all of a sudden, because this is one of the harshest downturns we've probably ever seen in the history of the markets. And I know a lot of people did not see that coming. However, the good news is that we have recovered much of the losses from February and March, especially from the NASDAQ. And I know a lot of people are thinking, well, how could this be? Well, the economy is not so great. There's a lot of mass unemployment. But then again, the stock market does not really reveal the true economy, especially for the average person. And I do believe this sudden sell-off and rebound was basically a true controlled manipulation tool to basically allow the markets to crash so they can buy and sell, make lots of money, consolidate, etc. And they can basically use as the whole virus epidemic as a scapegoat to basically cover up what is exactly going on. And yeah, I know the virus epidemic is a concern, but they're overhyping it to basically get people all scared up. And when they see these numbers change so much in the markets, they make people feel like, oh my gosh, it's like the end of the world. And I was kind of frightened too. A lot of my success was just being wiped out. And that's just what it is. We have essentially very few individuals that control so much of the stock market. But it isn't just that. One of the other signs is the fact that we've been seeing some improvements in the outbreak. We've been seeing more and more businesses opening up. People are more optimistic. People are having better forecasts. And one of the things you have to keep in mind, though, is that you need to look at earnings too. Now, I know a lot of earnings have come out. A lot of the earnings is first quarter, so I guess it's not really all that relevant, but we have to look at second quarter earnings and see how that will come out. So I think we can see a significant correction. But other than that, what is going on? Based on this major reaction to the markets, especially on the NASDAQ, this does not seem to be a dead cat bounce. It seems to be pretty much a good, decent, healthy recovery. And, a dead cat bounce is usually when you recover like 40, 50%, and then when you crash down. But as you can see here, year to date, believe it or not, the NASDAQ has barely changed. And guess what? The NASDAQ 100 is actually higher for 5.5%. And a lot of you are asking, why could that be the case? Well, because unlike the Dow Jones, which consists more of airlines and tourism companies, correct me if I'm wrong, the NASDAQ heavily consists of tech companies, particularly the NASDAQ 100. Amazon, Facebook, Google, Netflix, a lot of these companies, and they haven't suffered too much as a result of this outbreak. And many of the areas that they have headquarters and companies, they haven't seen massive job losses, unlike here, particularly in Las Vegas. However, I know that we're going to be seeing some much more higher moves, as I can see in the coming months, because based on what I'm seeing here, it's looking really, really optimistic, and not to mention the fact that more states are opening up. Keep in mind, though, it's not just earnings, but the financial system is in a lot of turmoil, because we've talked about how the banks are increasing their lending standards and how it's so dependent on very low interest rates, not to mention the fact that housing sales are starting to fall down, so that can have a more domino effect in the economy. So can we see a double dip? Certainly it's on the table. I can see that very likely after the next election. So let's take a look at the charts. The NASDAQ has strongly outperformed the Dow Jones Industrial Average. You can look at this from a 6-month chart, we're significantly higher. And from a 1-month chart, 1 year as well, The NASDAQ 100 is up about 21%. Wow. So we have seen a significant increase over time. Meanwhile, the Dow Jones is negative 8%. So I know this is kind of interesting to see, but the NASDAQ and the Dow Jones, there's kind of a detach going on, kind of like what happened in the bursting of the dot-com bubble, where we saw the NASDAQ crash like 60, 70%, but we saw the Dow Jones fall only about 30%. So, and speaking of 30%, I mean, we saw a decline in Dow Jones in about the same amount in a matter of a month or so. This is just so unbelievable. But it was very, very hard for me to see this significant decline. It was just unbelievable. But I told you many, many times, it's not like the end of the world. There's very likely that there was going to be a rebound, and that's exactly what we saw. And so let's just take a more look of the other asset classes. You can see here, crude oil has made a significant rebound. Let's take a look at the 1 month chart. You can see here it had a huge significant decline. I believe it was below $1. And now you're seeing this significant rebound. But keep in mind, though, the problem with that is we haven't seen too much of a discount in our gas prices here in the southwest region of the country, because I believe they're manipulating the prices, not just in California, but the nearby states as well. A lot of people don't know. Let's take a look at gold. As you can see right here at $1,700. Now, I know a lot of people are saying this is a good buying opportunity for gold. People are saying, oh my gosh, it's a hedge against inflation. I see gold as more of a hedge against deflation, because we kind of did see a lot of deflation in the last couple of months. But let's take a look at the maximum chart. And despite a lot of claims out there that, believe it or not, people keep saying the dollar is going to collapse, and we really haven't seen that yet, that gold is going to shoot up to the moon. Keep in mind, gold is at $1,700 and is still well below the all-time high of about $1,900. So medium and long term, I am not looking bullish for gold. And there's a lot of pumpers out there, a lot of scare tactics. Beware of those people. There's a lot of these channels out there. Greg Manarino, Mike Maloney, SGT Bull, basically USA Watchdog, Greg Hunter, Peter Schiff. A lot of these guys out there, not very good track record. And of course, there's a lot of people who don't have good track records too, like Jim Cramer and so forth. But I'm going to do more videos exposing them. And also I'm going to do a video about this YouTube channel called Game of Trades, because a lot of his videos is just constant bearish. And, 2 weeks ago, he says the stock market's going to crash. He said the stock market's going to crash 9 months ago. And it's kind of like this broken clock, kind of a track record thing where they get right once in a while. These doom and gloom people add a lot of fear. It brings a lot of viewers into their channel, a lot of drama. And that's exactly what happens as a result. So they get the news cycle of sheep that lures them in. So stay tuned, as I'll have more videos to come. Let's take a look at the 10-year bonds. Let's see right here. We're still near all-time lows, but it does not seem that we're at all-time lows. I think the only direction we can go is, at this point, is up. And obviously, as you know, I am not looking too optimistic about bonds, depending on the bond as well. So let's take a look at some of the articles that's happening. And again, I know that the unemployment rate is very, very miserable, but then again, the stock market is based on a lot of other factors, fundamentals, safe havens, basically the global earning economy. These are all these other things you have to consider. It's not mainly based on the health and well-being of the middle and lower classes. So this is an article. Now, this is CCN. I don't really believe in a lot of their articles, but they do have some good points. I know they're too much of a doom and gloom. How deflation could doom the economy and create a Great Depression. Now, I've talked about this before. Deflation overall does not have to mean a weakening economy in terms of standard of living. Now, you may argue the GDP has come down, and this is the arguments made about immigration. If immigration levels go down, so will the GDP won't perform well. But remember, the most important thing is the standard of living. So if we have mass deflation, especially in college tuition, in housing, and healthcare, that's actually good for our economy. Now, while that may lay people off, that means a lot of people out there will have higher purchasing power, and that will allow people to spend in their economy more. Now, yes, it will create a lot of lack of confidence, but then again, it's needed so people can create savings. People can basically make sure that they have enough disposable income to basically save, start new businesses, to basically buy other goods and services. So I know there's a lot of short-term pain, a lot of joblessness, but then again, you have to keep in mind though, in the long term, it can be pretty beneficial. But remember, the most important thing is the cost of living changes underperforming wage growth? That's the most important thing. So wages may fall down 3%, but we may have a deflation rate of 7%. And that's probably better than what we've been having for the last several decades, an inflation rate of 5%, but wage increases of literally 2%. And by the way, a lot of the inflation that we've had, a lot of the wage growth has been shuffled up to the top 10% of Americans. And it's not just people like me who know the investment markets, it's people who've basically rigged the system, you know, the union busting, the outsourcing, the reliance on foreign labor, etc. So let's take a look at some of the comments and see how this is good. Deflation is a result of demand falling, but not the cause of it. It's only the symptom of the economy slowing down significantly. Lower price actually encourages consumers to start buying again, which leads to recovery. And again, that's one of the reasons why when we had the financial crisis afterwards, the recovery wasn't so good, because we had mass inflation in food, fuel, healthcare, tuition, and housing, and that's not really good. We need mass deflation in housing so people can afford homes again, and I think that's especially coming with these new manufactured units or 3D printers that's going to come along. Now here's another article I want to talk about. The normal economy is never coming back. Well, this is no surprise, and I think this outbreak was really done as a result, as a catalyst to bringing down. The GDP will be 1/3 lower than the beginning of 2020, and it certainly fall faster than the Great Depression of the 1930s. As recently as 5 weeks ago, at the beginning of March, U.S. unemployment was at record lows, and then it surged. And you can see here, retail, real estate, education, entertainment, restaurant, where 80% of Americans work together. Remember, we're largely a service sector economy, including my employment. We're not so much focused in working in factories or working in farms, which are very productive. And by the way, over time, those employment will be changing due to technology. But a lot of these jobs will be permanently lost that we just saw. So I don't think a lot of those jobs that we saw losing in the casinos here in Las Vegas are coming back anytime soon. And look, it's hit Italy, Germany very hard. And what do you guys think about this? This is looking very scary. I think you're going to see a lot of crazy people, more homelessness, potentially a lot of crime. And again, I'm not really seeing a V-shaped recovery, especially for the average person. Now, we've seen that for the NASDAQ composite, but we certainly have not seen this for the average individual. So, my goodness. And especially, I think that the stock market, I wouldn't be surprised if it had turmoil, especially after the election. Now let's take a look at this article, why the commercial real estate bubble is about to burst. I think I showed you later. I think another issue that's really a huge concern behind all this is that commercial rents are too high. So I think it's pretty likely that they'll have to bring down rents to encourage more tenants to come back in, especially with e-commerce becoming a significant part of the economy. Although that, I don't think that's the only reason why retail has been struggling over time. And by the way, I think we just have, I don't know about you, I feel like we have too many restaurants in town. Just every single retail pad has been restaurant after restaurant after restaurant. And just so many people are working in jobs dependent on paycheck to paycheck. About, I think, 80% of millennials, my generation, are so glued into it. And it's one of the reasons why millennials are not happy, along with the fact that they're not building families, they're not having children. There's a lot of single mom households, and it's just a lot of depression, high welfare use, etc. And I know a lot of people argue that we may see lots of inflation because a lot of people are going to go on welfare and there's shortages of food. Not that many people want to go to work. I don't know about that. I don't know if the unemployment benefits pay so well in many other states. I think they can possibly raise wages a little bit to encourage people to come back to the workforce. And I do think that a lot of these food supply shortages are likely to be short term because, again, I know like several years ago we had like a shortage of cattle, but then beef prices tumbled the following year. And by the way, if you look at the commodity price index, the feeder cattle index has not reached all-time highs and has not spiked recently as far as I know. All right, everybody, thank you guys so much. Please stay tuned. Please subscribe. Please share this video as you can. Take care, stay safe, and please remain optimistic. I know we can get through this.